Citibank branches are closing worldwide. The U.S. economy is in big trouble. The sudden downfall of Citibank sent shockwaves through the financial world, leaving many questioning its stability and implications for the broader economy. The 2008 recession hit the company hard, and it has been struggling to recover since then. In the last 5 years, the value of Citi stock has dropped a lot, and the bank has faced many difficulties and has not done as well as others. The repercussions of Citibank's failure were felt across various sectors, causing economic setbacks for the country. Citibank's failure had a big impact on the U.S. economy, leading to significant financial losses. The CEO of Citigroup, Fraser, realized that big changes were needed. So the company decided to stop doing business in 13 foreign countries and focus more on what it's good at, like helping rich people with their money. This new plan is meant to make things simpler and hopefully make the bank more successful again. People are now wondering if this new approach will work and if Citigroup can become a strong bank once more. We will be discussing that in a while. We put enormous effort into producing data-driven content to show you what's fake and what's real. Subscribe and comment to The Final Economy. Citigroup, also known as Citi, is the fourth largest bank in the United States with $1.6 trillion in assets and 72 million customers. However, despite its size and recognition, Citi has a troubled history, especially since the 2008 financial crisis. The crisis severely affected the bank, and its share price is still 90% below its pre-crisis peak. This leads to severe effects on U.S. economy too, leading to higher inflation. For the second quarter of 2022, their long-term inflation forecast, which is a prediction of the inflation rate over 10 years' time, went from about 2% to about 2.3%. Citigroup, once a dominant force in the financial world and the largest bank in the United States, has experienced a roller coaster ride over the years. From its origins in 1812 as the first national city bank to its pinnacle as Citibank, the institution's growth was fueled by innovation and strategic mergers. However, the 2008 recession dealt a devastating blow, causing a collapse that has left the bank struggling to regain its former strength. Over the last 5 years, Citi stock has seen a significant decline of more than 30%, leading to numerous challenges and underperformance across various financial metrics. The rich history of Citigroup traces back to its modest beginnings in 1812, when it was established as the first national city bank. Through a series of mergers and acquisitions, the bank rapidly expanded, eventually reaching a position of dominance as Citibank. The rise to become a financial powerhouse was driven by the institution's commitment to innovation and strategic partnerships that opened doors to new opportunities and global markets. Citibank's failure significantly impacted the U.S. economy, resulting in substantial losses. The country faced severe supply chain constraints, including shortages in labor, semiconductors, lumber, and packaging materials. These shortages hindered the economy's ability to rebound effectively and contributed to inflation fears, as companies were forced to raise prices amid low supplies. The labor force participation rate remained well below pre-pandemic levels due to the lingering effects of Citibank's failure, with many Americans still unable to return to work. Generous unemployment benefits and child care duties exacerbated the situation, leading to a shortage of available workers to power the grand recovery. One of the reasons for Citi's struggles is its low valuation compared to other major U.S. banks. Investors believe the company is worth much less than its actual value if it were to be liquidated, with a price-to-book ratio of just 0.6. Since the 2008 recession, Citigroup stock price has witnessed a significant decline, reflecting the bank's struggle to regain its former market value and investor confidence. Over the last few years, the stock price is continuously falling, which is impacting the bank's performance compared to its competitors. The 2008 financial crisis dealt a severe blow to Citigroup, shattering its position as a leading bank. The recession exposed the bank's vulnerability to risky assets, particularly subprime mortgages, resulting in significant losses and a near collapse. The aftermath of the crisis led to a struggle to recover and rebuild the bank's reputation, a process that continues to this day. Citibank has faced regulatory issues and was fined $400 million by the Federal Reserve and the Office of the Comptroller of the Currency. The Federal Reserve has criticized Citibank for poor oversight and risk controls in a report. Citigroup has faced numerous challenges and underperformance across various financial matters in recent years. Despite efforts to recover from the 2008 recession, the bank has not been able to achieve the desired level of profitability and efficiency. This underperformance has put pressure on the bank's management to identify and address the underlying issues slowing down its growth and success. This decline has posed significant challenges for the bank as it has failed to keep pace with its competitors in terms of stock market performance. The scarcity caused by Citibank's failure affected consumer confidence, resulting in reduced spending and a slowdown in various industries. As the current CEO of Citigroup, Jane Fraser, assumed leadership with a bold vision for transforming the bank's trajectory. Jane Fraser has had an 18-year career at Citi, holding various leadership roles across the consumer and institutional businesses. Before becoming CEO, she was the president of Citi and CEO of the Global Consumer Bank, responsible for all of Citi's consumer businesses in 19 markets. Recognizing the urgent need for change, she began action on a strategic shift to address the bank's challenges and improve its performance. Fraser's leadership has been marked by decisive actions aimed at redirecting the bank towards a path of sustainable growth. In a strategic move to simplify its operations, Citigroup made the decision to exit 13 retail markets outside the United States. This decision aimed to reduce complexity and allow the bank to focus on its core strengths. By streamlining its international presence, Citigroup sought to achieve greater efficiency and effectiveness in its operations. Under Jane Fraser's leadership, Citigroup strategically shifted its focus to emphasize wealth management. This decision was driven by the potential for higher returns and growth opportunities in serving affluent clients. By capitalizing on its expertise in this area, the bank aimed to strengthen its position and financial performance. In her remarks at Citi's 2023 annual stockholders meeting, CEO Jane Fraser expressed pride in Citi's role as a source of stability for the financial system and support for their clients during times of volatility. She attributed their ability to do so to their efforts in delivering a simpler and more focused Citi, benefiting from a diversified earnings mix and a resilient business model. Citigroup's redirection towards wealth management and the strategic exit from certain foreign markets holds the promise of elevating the bank's overall performance. By concentrating on core strengths and aligning its business with the needs of wealthy clients, the bank aims to achieve improved financial outcomes and enhanced shareholder value. For the full year 2022, Citigroup reported a net income of $14.8 billion on revenues of $75.3 billion, compared to a net income of $22.0 billion on revenues of $71.9 billion for the full year 2021. Citibank's Common Equity Tier 1 capital ratio at year-end 2021 was 12.2%. Overall, Citibank has a solid balance sheet and a liquidity coverage ratio of 115%. For the first quarter of 2023, Citigroup reported net income of $4.6 billion on revenues of $21.4 billion, which increased by 7% from the prior year period. Despite past difficulties, Citigroup's strategic shifts offer promising potential for a resurgence. By focusing on its core strengths and embracing the wealth management sector, the bank aims to create a more efficient and profitable operation. During the early 2000s, Citi heavily invested in mortgage-backed securities and other risky assets tied to the booming real estate market. When the 2008 housing bubble burst, Citi suffered massive losses, leading to a $27 billion net loss for the year. To prevent a complete collapse and avoid a financial catastrophe, the U.S. government provided Citi with a $45 billion bailout. This bailout, however, was controversial and led to the government becoming Citi's largest shareholder, owning 30% of the company. Since then, Citi has worked to recover and scale down its operations. The bank has gradually divested underperforming international businesses and focused on increasing efficiency and profitability. They appointed a new CEO, Jane Fraser, who plans to divest their consumer banking businesses in several markets to simplify their operations and boost their return on equity. Despite efforts to recover, Citi's share price has underperformed compared to its peers. Investors are concerned about its low return on equity and the complexity of its international operations. The financial world is closely watching Citigroup's strategic shifts and their impact on the bank's performance. While there is curiosity about the potential for positive change, there is also skepticism about the challenges that lie ahead. Observers and investors are eager to see how these changes will play out and if they will lead to the desired outcomes. As Citigroup focuses on wealth management and simplifies its operations, the central question remains: will this new direction lead to sustained growth? The success of these strategic changes will be a critical factor in determining the bank's future trajectory and its ability to reclaim its former glory. For Citigroup, the path to redemption is undoubtedly challenging. Overcoming the aftermath of the 2008 recession and charting a new course requires careful navigation and a clear vision. The bank must address historical setbacks while positioning itself for future success in a competitive financial landscape. The financial industry eagerly awaits Citigroup's next moves as it seeks to reclaim its former glory. While the challenges are substantial, the bank's renewed focus and commitment to strategic change suggest that a turnaround may be possible. The success of Citigroup's new strategy and its journey toward redemption will be revealed over time. As the bank implements its changes and adapts to market dynamics, only time will show the true extent of its resurgence and whether it can reclaim its position as a financial powerhouse. In conclusion, Citigroup's journey from a historical financial powerhouse to facing turbulent times has been a challenging and transformative one. The 2008 recession dealt a severe blow to the bank's reputation and financial standing, leading to years of struggle and underperformance in the market. However, under the leadership of CEO Jane Fraser, Citigroup embarked on a bold vision for change, seeking to simplify its operations and refocus on its core strengths, particularly in the wealth management sector. While the strategic shifts offer promising potential for a resurgence, there is both curiosity and skepticism surrounding their success. As the financial world watches with anticipation, time will ultimately reveal whether Citigroup can reclaim its former glory and emerge stronger in the competitive financial landscape.